You're unmuted. And you're good to go. Okay, yeah. There you go.
Nice to meet you, Grant. Okay, thank you.
Yeah.
Yeah, there, yeah.
Thank you.
Thanks. All righty, we'll get started, guys. Again, I'm Dana Clayton, Shay, right? Jamie, RJ, Emily, and Bart. Okay, so let's get started. Today we're going to be talking about some interesting concepts. We're going to talk about seller concessions and how they work, how to avoid closing delays, appraisal, inspection, and repair negotiations, and clear to close, what happens at the end. Feel free to stop me anytime with questions, guys. That's what we're here for. So let's talk about seller concessions. Everybody know what seller concessions are and how they work? Okay. Well, let's talk about some things, pieces in here that you may not be aware of when it relates to seller concessions. First of all, seller concessions or seller credits are basically contributions that the seller makes to the buyer for their closing costs. Okay? Seller concessions cannot be used for down payment. Okay? It can only be used for closing costs. So what happens is, typically, the closing costs, instead of lowering the sales price, for example, we'll walk through some examples of this. The seller offers to help with the buyer's out-of-pocket expenses, again, the closing costs. Here's a piece that I don't know if most people know about, but seller concessions vary by loan type. Okay? So for a conventional mortgage, typically, or conventional loan, typically, the seller can contribute up to 3%. This is what you see most often. However, did you know that that is only true if the down payment is less than 10% of the purchase price? If the buyer puts down between 10 and 25%, those seller credits can go up to 6%. And if the down payment is greater than 25%, the seller credit can be up to 9%. Now, obviously, this is not very typical, right? If you've got a buyer who has 25% down, most of the time they can cover their own closing costs. But it is an interesting fact. For investment properties on conventional, the maximum is up to 2%. Okay, so for an investment property, it's 2%. FHA loans, the seller can contribute up to 6% of the purchase price. VA loans, up to 4% of the loan amount. Okay, and typically with a VA loan, there's no down payment, so the purchase price and loan amount are the same. And with USDA, up to 6% of the purchase price. Now, why do I have up to underlined? Again, the point here is the seller can contribute up to those percentages and not over. Again, if my closing costs are $10,000, okay? My closing costs are $10,000. The seller cannot contribute up to $11,000. Cannot contribute $11,000. They can only go up to the closing cost and nothing more. A buyer can never get a credit back at closing because they received $11,000 in closing costs and they only needed 10. They're not gonna get $1,000 back at closing. Okay, that's not allowed. And again, the seller cannot contribute toward the buyer's down payment. That's why it says up to those percentages. Is that clear? Does it make sense? Up to 6%, for example, without going over. If my contract reads up to 6% and my closing costs were only 5%, then that's where it stops, 5%. Okay, good? Let's look at an example. The first example is in a, let's say in a non-competitive situation, the list price is $400,000. And the buyer says, okay, I'll offer you $400,000, but I want $12,000 or 3% in seller credit. The seller says, okay, we'll do that. The seller walks away with $388,000, and it says in that proceeds, that's assuming they don't have a mortgage that they have to pay off or anything, right? But this scenario doesn't happen as much as it used to. Now, it might happen if the house has been on the market quite some time and the seller needs to sell. Typically, what you find is the scenario B or something in between, some kind of negotiation in between. So in scenario B, the buyer is offering above asking price. So again, it's listed at $400,000. The buyer says, okay, we'll give you $400,000, but we want to get money back in closing costs, so we're going to offer you $412,000. You give us $12,000 back at closing for our closing costs, and you walk away with your $400,000. So scenario B seems to be happening more frequently or somewhere in between, some kind of negotiated price in between. That makes sense? That's the gist of seller credits and how they work. Any questions on it at all? Do you have any type of scenario that you want to run past me or anything? You can negotiate that as well. But in that case, if you're taking a reduction in your commission, it's going to either be less money out of pocket, because typically, I don't know if I should say this legally, but typically the seller pays the commission, right? So if you were to reduce your commission, it would theoretically reduce the sales price of the house, thus helping the buyer by the reduced sales price. This is pretty frequently with first-time home buyers in that they just don't have the cash to cover down payment and closing costs, so they need some money from somewhere. And a totally different topic, but down payment assistance programs are expensive. And by that I mean the interest rates are much higher. So it's cheaper to negotiate seller concessions than it is doing a down payment assistance. Does that help answer your question? This is really about, you know, the other thing I'll say about seller credit. Your closing costs run, your buyer's closing costs run somewhere between 3 and 5% of the purchase price. Expensive, especially in Fayette County where we accrue 6 months of property taxes in your prepaid. So if you think about 3% of 400,000 is $12,000 bucks. 5% of 400,000 is 20,000. So you're running somewhere between $12,000 and $20,000 out of pocket to cover closing costs, plus down payment, right? So seller credits are a big negotiation tool for your buyers, when you can help negotiate seller credit. Let's talk about, totally switching gears, what to avoid and some of the common mistakes made by buyers, and then we'll talk about some of the common mistakes made by agents. This happens more frequently than you think. I've had it happen to me several times, where the buyer, I had a situation where the buyer quit his job 2 weeks before closing. Okay, they said, you're gonna have to go to Florida and do a job. He didn't want to go to Florida until after he closed, so he quit and lost the house.
Before closing or after closing?
He quit before closing, 2 weeks before we were supposed to close. Everything was looking great, but then you quit your job, that's it, right? They being the underwriter and the team, will do a verification of employment within 10 days of closing. So don't quit your job. Try not to change your job. We can get through a change in position, especially if it's a step up and not a lateral move. We can get through that, but it could delay your closing for sure. Don't open new lines of credit. You'll be surprised. You hear the horror stories of, and I've had this happen too. The buyers, again, we were a week or so out from closing, they went and bought a new car. Not only killed their debt to income ratio, but crushed their credit scores. So, whereas your lender has these conversations with your buyers, have them as well. Yes.
Isn't number one not to pay off the credit card?
Yes. Yes. And especially, you can certainly pay them down or pay them off, just don't close them. Okay? Don't close lines of credit. Believe it or not, open lines of credit can help your score, especially if they have low or zero balance. Don't deposit large amounts of cash. You would be surprised. I come from a small town, Bardstown, Kentucky. Urban capital of the world, and most beautiful small town in America. But where I'm from, people keep safes in their houses, and they keep large sums of cash in those safes. You can't do that and buy a house. Okay? You can't take that money, oh, I've got $5,000 in my safe, or whatever the amount is. I'm going to take it and go deposit it into my bank account. I'm going to use that for my down payment. No, they will not allow you to do that. Cash has to be what is called seasonal. It has to be in your bank account for at least 60 days, or 2 full bank statements. Okay, once it hits 2 full bank statements, it's considered seasoned. It's considered usable at that point. Plus, underwriters only go back 60 days. They're only looking for your last 2 months of bank statements. Okay, they won't see that large deposit of cash. If they do see it, they're going to want explanations. And when you say, well, it was cash in my safe, they're going to say, we can't use it. Okay, so not that you're going to have that personal of a conversation with your buyers, but if you know your buyer is well enough to have that conversation, and you know their history such that they don't have a lot of credit, they don't use credit cards, they pay cash, it's worth having that conversation. Delaying documentation is another topic that will obviously delay closing. If your buyer is not really good at communicating, answering emails, even looking at their email, this could really hurt your closing. It is so imperative, because during this process, buyers will get emails almost every day, every other day. Okay, pay for the appraisal. Your appraisal's back. Here it is. We need another bank statement. We need another pay stub. Hey, you just cleared underwriting. You know, there's constant communication throughout this process, and it's so imperative that they are looking at and answering emails. If they say it's, you know, it's Monday, I got this email, well, I'm busy this week, I'll get to it this weekend, you could literally just delay the closing by a week. Okay? So, being responsive, being on top of it, helping your buyers be on top of it is critical during this phase. Not reviewing the closing disclosure, what we call the CD. Buyers will get the CD, a preliminary CD, at least 3 days prior to close, at least. A lot of times it could be a week, closer to 2 weeks. You know, it's important. I'm looking at them all the time. I'm checking them line by line by line to make sure everything's on there. But there's things sometimes that I might miss. For example, if you charge your buyer a transaction fee, then I don't know it. Chances are it won't be on there until you actually get it and look at it. We'll talk about that in a minute, but this typically doesn't happen on my side because I'm looking at it myself, but it is important that in addition to that, I actually review this with my buyers, line by line by line, to make sure, hey, this is the preliminary CD, it's not final yet, but here's what we should be close to when it comes to the day of closing. Preparing that buyer. A lot of times, even though they saw this weeks ago, when we did the initial loan estimate, they see this and it's still shocking. Okay, so I go through this with them line by line to make sure they understand it, but you don't ever want a surprise when it comes to closing day that, oh, this is not what I expected, kind of thing.
Say the average amount that it ranges. For example, if you might have 10,000 net, that would be much more. That's usually
Yeah.
During the range.
Well, then I can say what I do, and that is I overestimate at the very beginning, so that I'll say 99% of the time. I've only had this happen twice in 5.5 years. I always come in higher than the final, such that the buyer ends up owing less at closing than what I told them. I've only had 2 cases where I was off, and one was by $300, and I can't remember the other one, but it wasn't much. You never want this to happen. You never want it to happen. And you'll be surprised, especially lenders that are not local, lenders that are in California, never have to sit in front of that buyer. You'll be surprised how far off they can be. And they can end up owing thousands more than what they were told. But I always estimate too high. I'm very conservative, and I never lowball on that. This last one is coming up more and more frequently. I was really surprised by this because I've never had it happen before. And that is wire fraud. So what they are telling, we actually have it at the bottom of every email now, to tell buyers to be very cautious when wiring funds. Now, most of our buyers, I would say at least 80% just bring a check to closing, cashier's check to closing, but some do prefer to wire it. And apparently there's a lot of fraud going on where they are not verifying the wire instructions, and it's leading to fraudulent activity. So we are telling buyers to be very cautious. Obviously, not only is it fraudulent activity, but you definitely going to not end up being able to close. Any questions on some of the things to avoid? Well, let's look at the agent's side. Obviously, I hear this more often than not from anybody at Keller Williams, but throughout our industry, poor communication amongst realtors is one of the issues that can definitely delay closings. Other realtors not being responsive. So always, 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 when you, especially, I mean, that's money, that's your business, that's your lifeline. Be sure that you're communicating throughout the entire process. Making sure that you're not relying on others to communicate. Now, again, case in point with me, I have notes on my calendar that says every Monday, Wednesday, and Friday, I'm going to tell you what's going on with your transaction. Even if nothing has happened, I will tell you, I don't have an update for today. Nothing, we're sitting in queue, waiting on the underwriter to pick it up, or whatever that case may be, okay? I will always keep you informed of exactly where we are within the transaction. However, a lot of times, realtor to realtor, other parties involved may not communicate. So just be sure that you're getting regular updates on the transaction, and don't assume that somebody is handling something. Just follow up. Closing disclosure, like we saw on the last slide, be sure that you're checking the CD when it comes out to you. Make sure your transaction fees are on there. Make sure your commission is on there. Make sure there's anything that you negotiated as an addendum or anything is on there, okay? Just check it to make sure. If you have any questions, always, always reach out to the lender to be sure it's accurate. And lastly, just be sure to negotiate any type of contingencies and make sure you stay on top of those. Now, we're going to talk about this in a few minutes. There are some things that lenders don't want to know, okay, that are being negotiated on addendum for repairs and whatnot. There's going to be things we don't want to know, we don't want to be involved in, but we got to make sure, you make sure that you address those, and that all those contingencies and how they're going to be resolved, i.e. seller bringing a check to closing for the buyer, is all worked out and resolved. All right, let's talk about kind of a summary of those things we just covered. And again, just to reiterate some of these, you never want your buyers to change employment, quit employment, make large deposits, open credit lines. We want to make sure that we're reviewing the closing disclosure well in advance so there's no surprises. Be cautious of wire fraud. The other thing I'll say about wire transfers in general is the title company will provide instructions, okay, for a wire transfer. Title company will provide instructions, and sometimes it even says on there, when you go to the bank to do your wire transfer, call this number. And that verifies that it's an accurate wire transfer. And lastly, just be sure to always have clear channels of communication. This one bullet that I didn't talk about that I really like, and I've heard realtors doing this, is they have this, I don't even know what it's called, a little system that tracks everything to keep everybody on track. Like it tells the buyer, here's what day you should change your utilities or change your address at the postal, at the U.S. Postal Office. Things like that keeps everybody on track. I don't know the name of the tool, but they're kind of cool. And here's the day of your appraisal. Here's the day of your inspection. Here's the last day we can negotiate repairs. I don't know, like I said, I don't know. Does anybody know what that's called? Those tools. But it's automated and it's really cool. So just a way to keep the lines of communication open and clear so that everybody's on the same page. Okay. What lenders care about and what they don't. Obviously, we care about the appraised value, okay, because we can only lend the lesser of the appraised value of the person, okay? So we do care about the appraised value, and we care about the repairs required by an appraisal, such as an FHA, loan and an FHA appraisal. Those repairs have to be made before we can close. Okay? So we do care about those things, but we don't care about cosmetic repairs. Okay, your buyer doesn't like the color of the paint or the color of the carpet. We don't care about that. It does not impact the loan in any way, shape, or form. Any such negotiations we want to keep out of the loan process. And the last one, especially, if your seller and buyer negotiate repairs, we want you to keep that outside of the contract, outside of the, it'll be an addendum to the contract, but we don't want to keep that. We don't want to include that in the price of the loan or the cost of the loan whatsoever, especially if there are seller concessions. Okay, so let me elaborate on that. You had a situation, let's go back to that example where the house was $400,000. And you successfully negotiated 3% in seller credit, $12,000. So let's say it's a conventional loan. Then, in that case, seller concessions are maxed out. They cannot be any more than $12,000. That's what the buyer's going to get. Mm-hmm.
Kind of what I asked earlier. So you say you can't do more than 3% seller concession. Can I do 3% seller concession and then my 3% commission?
Yes. Okay. Because the seller's going to pay that 3%.
Regardless.
Yes. Yeah. Yeah. Yes. But let's say that again, you're maxed out in seller concessions at $12,000. Now you have the inspection, and inspection comes back and says you need a new furnace or you need a new hot water heater or whatever, and now the seller says, I don't want to be bothered with any of that. I'll just give you $5,000. If you turn that in and try to put that on the closing disclosure, you won't be able to because you've already maxed out at $12,000. You can't have $17,000. Okay?
So Dina, how would you reference that in the contract? I know you said
Okay.
addenda, but in the purchase and sale, the main
Yeah.
value of the contract, you must say, reference this addenda, and then further explain whatever's going on.
You put it in the addendum. Exactly.
And just reference that.
If you say,
The TNS.
seller agrees to pay buyer $5,000 at closing in lieu of repairs. Then the seller will bring a $5,000 check, hand it to the buyer at closing, and it never enters the mortgage process. And that's how we want it.
Like, it's just,
I'm sorry, it's just
saying again.
Just a
you don't say the word gift, but it's in lieu of repairs.
Or they can make the repair.
Or they can make the repair.
What about reducing, seller agrees to reduce the cost of the purchase price by $5,000?
Well, that happens, and you're 2 weeks away from closing, chances are you're going to delay the closing, because everything has to be redone. It has to be changed, the purchase price has to be changed, we have to change the loan documentation, it has to go back to underwriting, everything has to, now, will it be another 4 weeks? No,
Those would be two.
but it could be 2, and it could delay, because you gotta sit in line again. Okay, so it is always best, I hope I'm not saying anything illegal here, I'm being recorded, but it is always best to try to negotiate that definitely outside of what we say is outside of the closing, even though it happens at the closing, we're saying outside of the closing in terms of the loan closing. Another thing that can happen too, I've seen this several times, and that is instead of the seller bringing a check, the title company will just reduce their proceeds. Okay, that can be. However, the seller, buyer, and realtors want to work it out. Great, we just don't want to be involved. It's better if we don't know anything about it.
Isn't that kind of what reducing the sales price? Not
No, because everything stays the same until they get down to the proceeds line and what cash, what check they get back.
So then they can figure out how they want
Yeah.
to.
That's the best two ways, either reduce your selling proceeds at closing or bring a check. 9 times, more often than not, selling this check. Okay? Is that clear? Because that's pretty important, what we care about, what we don't care about. That's one of the big ones. We don't want to be, we talk about it as we are kind of a third party and we just don't want to know those things because it can open up cans of worms. Keep it outside of the loan process. Plus, you don't want to impact your seller concessions if you have some. Here's something that you might find surprising. A lot of people think that once we get the clear to close, we're done. We're not done. Clear to close is just another step. I tell people this all the time. I don't know if you realize it or not, but I've counted at least 10 people, 10 different people that touch a loan. Okay, it's not just the loan officer. There's 9 or so other people that are going to touch that loan and look at that loan. But clear to close is not the end of the story. What happens after clear to close? After the clear to close, it goes to the quality control department. Quality control is just an audit, making sure all the I's are dotted, T's are crossed, every single documentation is there. Don't confuse that with the underwriter. Now, the underwriter is making sure that it meets all the federal guidelines, okay? But quality control is just like a car rolls off the lot at Toyota. At some point, it's going to go through a quality control check to make sure everything about that car is okay. Same thing with the loan. Quality control could pass it. Most of the time they do, but they could find defects. What's an example I've had, like a true example? I've had a case where someone had been incarcerated and there are discharge papers and we supplied certain pages of the discharge papers and quality control came back and said, you got to have something else, additional pages or whatever that case may be. But that's what quality control is looking for, okay? After quality control passes it, it's going to get the approval for funding. Now funding, what is funding? Well, funding is where you actually go to the closing and the funds for the loan gets dispersed to the title company so that the title company can disperse the funds. Okay? Without funding, well, a lot of times it's called a dry closing. The funds didn't get dispersed, so it's really not done. You may have signed the papers, but theoretically, and you may have walked out with the keys for that matter, but if it's not funded, it's not done. Once the loan gets approved for funding, not funded yet, the funding department, the closer, will balance with the title company. Now that process can take a while. It might take 1 or 2 days in and of itself. Okay? Especially if the closer and the title company aren't balanced. Okay? Someone left off taxes, someone put too much taxes in, someone forgot the transaction fee, someone has the wrong payoff, whatever the case may be. But until these two balance, you're really not done yet. Once they are balanced, the final closing disclosure is now ready. The final CD, also called an ALTA, that will go out, or a settlement statement. We representing the buyer, I look at the final CD before I look at anything, because that's what I've got to go over with my borrower. Explain, hey, you saw the preliminary CD 3 days ago, you just went down by another $500. It was because taxes got adjusted. Here's your final number. And then I give them closing instructions. I say, here's your final number, bring a cashier's check and the exact amount of, made payable to, see you Friday at 1 o'clock for closing. And of course, then there's closing day. Now, just a note, from the moment you get it clear to close to the day of closing can be several days. It is not the same day. You sit in line with quality control, you sit in line with the closing department, just like you do the initial loan processing or underwriting. You're in a queue waiting to be picked up. Okay?
So then, the clear to close, the initial clear to close, does that just refer to that initial DD being, produced and given to the realtor to look at, and title being cleared by the attorney or the title company, like no clouds, et cetera, we're cleared to move
Yeah, it is a little bit more than that. It does mean that you've cleared underwriting. Underwriting's not gonna ask you for anything else. So it is, I guess, it is the milestone that everyone always looks at and talks about. Yay, we got to clear to close. And you're gonna close, but there are other steps involved. Okay, it doesn't mean we're clear to close, we can close in 5 minutes.
Yeah.
Or, because I hear that all the time. Realtors will call up and say, we got to clear to close, can we close tomorrow? No, there's still a lot that has to happen. And that's just me bringing awareness to you guys that, yeah, we got to clear to close, but there are other things that happen after that. Just kind of help you in your mind realize what kind of happens after the fact. Any questions? I think that was my last slide. Let me check. Yeah, that was it. Any questions? I know that was a potpourri of different things, of seller credits to what can delay closings versus those things. Yeah. Yeah.
Wow, stretching, I'm sorry.
You stretch it.
So when you're writing your contract, you can still pick your moving target closing date. And then as you get that initial clear to close, check in with all the powers that be. Are we still good for this date, or
Yeah.
do we need to push it out?
Or do we want
Or
to
can we move it forward,
Mhm.
depending on that last 2 to 5 days of
Yeah.
quality control, et cetera, correct?
Right. And it's typically, here's the thing about changing closing dates that I really didn't cover. Ideally, we want to try to do a good job of projecting that closing date up front. And the reason is because all the documentation is tied to that closing date. If you start to try to move the closing date, all the documentation has to be redrawn up. Not only that, it includes having to go back to your homeowner's insurance company and having them adjust the date, especially if it's getting pushed out. So it creates a bunch of hoops to jump through. So what I normally do, a lot of times contracts will say these days, they'll say between 30 and 45 days to close. Okay? I start to talk to people immediately. Well, is the home vacant? Yes. Okay. What do you prefer? And I start to nail that date down sooner rather than later. And I go ahead and I put in that date. Well, I have to put in the date up front. And then we adjust it as a week or so goes by. Because to your point, Emily, well, what if it has an inspection and the inspectionist that comes back and they need a lot of repairs?
Right.
And it's going to take a while. Obviously, if we've got that 30 to 45 days, we've got a window there where we can push it out if we need to. But the sooner we can address that date, the better. Again, just to make sure all the documentation is there before it hits the final. I mean, if it's gone to the closing department and they're balancing using that date. And another thing is not only obviously is the date on all the documents, but prepaid interest is approved based on that date. So the borrower's numbers will change. What they owe will change based on that. So there's a lot of things to consider there. So it's just better if you can start to nail that down sooner rather than later. What other questions?
I can't really remember, but Why is this that, I guess, one, because they have the approval amount, I can't remember exactly what it is. And they're literally about to close, more, I guess, more documents are being asked, you know,
Yep.
you're asking for more
Yep.
documents. And then
Yeah, more conditions. Or,
is it just, they just came up, or?
it can be a number of things. A lot of times it comes down to communication, or perhaps the borrower dragging their feet in terms of getting documentation to the underwriter. But until all the conditions are met by the underwriter, okay, the underwriter says, you've got a current mortgage, I need your last mortgage statement. I still don't have proof that you have homeowner's insurance or on your current home. I mean, if there's documentation, typically it's documentation missing that the underwriter has requested, and they won't give you the clear to close until they have it. I mean, I've had conditions get cleared like 2 days before closing, and that is stressful. That is stressful. Because now you're just now getting the clear to close, and you still have all those things that have to be done. And you're cutting it very, very close. I mean, and not to put all the blame on the buyer, it could be something the seller has done as well, that they just haven't, they haven't given the invoices for the repairs or something. There's numerous things, but if you've got a solid lender who's staying on top of the conditions and staying on top of the buyer, you should not have that happen where you're at the last minute. But it does happen. It does happen. What other questions? Hopefully this was a little bit informative, a little nugget or two of some information for you. I appreciate you guys coming.
Thank you.
Thank you.